Okay, let's be real for a sec. If you're a BS accountancy student staring down the taxation board exam, you already know that memorizing the family code property regimes is an absolute nightmare. But what if we completely stop memorizing and instead start hacking your brain using high contrast logic? Today, we're going to entirely rewire how you look at the conjugal partnership of gains versus the absolute community of property. Welcome to your minimalist study guide. We're dropping the complicated jargon, the massive blocks of textbook text, and the endless sea of highlighters. This explainer is specifically designed with zero visual distractions, just 100% pure signal. Our goal? To lock these tax rules into your memory for the next 3 years. We aren't just cramming for tomorrow's quiz here. We are building serious mental architecture for the actual licensure exam. Here's our roadmap for today. First, brain hacks for the LECPA. 2, the August 1988 cutoff. 3, conjugal partnership of gains. 4, absolute community of property. 5, family code charges. And 6, we'll wrap up with the ultimate bullet review. All right, kicking things off with Section 1, brain hacks for the LECPA. You know that feeling when you read your tax reviewer for the 5th time and think, yeah, I totally know this? Well, actually, that's a total illusion of competence. We need to shatter that illusion right now using active recall. So throughout this explainer, I'm going to be throwing questions at you before revealing the answers. I want you to pause, guess the answer in your head, and then let the following information confirm it. Guess first, and I promise you, you won't forget it on exam day. Moving right along to Section 2, the August 1988 cutoff. Literally every single estate tax problem starts right here. Picture this. You're reading a massive board exam problem. Spouses, multiple properties, businesses, but wait, they have no prenuptial agreement. Take a second to mentally lock in your answer. What actually dictates the default rules of their marriage? Did you guess the date of the marriage? Because that is our very first mental anchor. You always check the date of the marriage first. August 3, 1988 is basically the magic cutoff. Married before this date, the default is CPG. Married on or after this date, the default shifts to ACP. If an exam problem hides the property regime but subtly drops their wedding anniversary, boom, that's your key to unlocking the entire computation. All right, on to Section 3, the conjugal partnership of gains. Think of the conjugal partnership of gains, or CPG, as the old school rule. It's probably the regime your parents or grandparents are under. And if you understand its core logic, you honestly don't need to memorize every single asset classification. Under CPG, property follows the source. Exclusive money buys exclusive property, common money buys common property. It's a system of 2 distinct separate foundations that occasionally decide to pool their resources. Okay, let's test that logic with an active recall check. Say the wife inherits an apartment building, making it her exclusive property. During the marriage, that building generates a cool $1,000,000 in rent. Does that rental income follow the exclusive building, or does it become shared? Lock your answer in. Surprise! In CPG, even if the property is entirely exclusive, the fruits and income generated during the marriage are always conjugal, so that rent money from her exclusive building, it goes straight into the family pot. Also, keep in mind, anything acquired by owner's title, meaning you actually worked for it or paid for it, is conjugal, but properties acquired gratuitously, like a donation or an inheritance, stay exclusive. Now, we've got to talk about exam traps, because the examiners absolutely love testing the extremes. Found a chest of hidden treasure? Conjugal. Went hunting or fishing? Also conjugal. But watch out for the gambling trap, it's a classic. If you hit the jackpot at the casino, those winnings belong to the family. But if you lose your shirt, those losses are exclusively yours. The family fund is definitely not subsidizing your bad habits. Transitioning to Section 4, absolute community of property. If you're planning on getting married today without a prenup, welcome to ACP. Under this modern default, the logic shifts entirely. You can throw property follows the source right out the window. The new rule is what's mine is ours. Everything essentially merges into one massive communal pot. But here's the thing. The examiners aren't going to test you on that general rule. No way. They are going to specifically target the mostly part, the strict exceptions. Time for another brain check. We know items for personal use are generally exclusive, right? Like you don't share your toothbrush and you don't share your shoes. But what if a husband buys his wife an ultra-expensive diamond necklace solely for her to wear? Think carefully here. Does the extreme luxury status of the item override the standard personal use rule? Did you catch the trap? Jewelry is the golden exception. In ACP, jewelry is absolutely always communal. It literally doesn't matter if it's strictly for her personal use. For estate tax purposes, it gets dumped right into the community pot. Also, check out how properties acquired by inheritance or donation during the marriage remain exclusive unless the donor explicitly states it's for both spouses. Now let's see how this builds into one of the most brilliant safeguards in the law, the prior marriage exception. Honestly, this is a massive, high-yield concept for taxation. If someone with legitimate children from a previous marriage remarries, the law steps in to protect those kids' inheritance. Any property brought into this new marriage, and even the income it generates, stays strictly exclusive. It does not merge with the new spouse's assets. Section 5. Family Code Charges. Let's shift gears to deductions and see how the Family Code handles debts and expenses. Active recall time again. We all know the family fund supports the legitimate kids, but what if one spouse has an illegitimate child from an affair? Apply some basic logic of fairness here. Who should actually bear the financial burden of this expense? It's all about fairness, right? Support for an illegitimate child is a deeply personal obligation, so it is strictly charged to the exclusive funds of that specific parent. Same exact logic applies to liabilities from a crime. But on the flip side, look at professional education. If you take a course to level up your career, that's going to benefit the whole family down the line, making it a conjugal or communal charge. The ultimate cheat code here? Just ask yourself, did this expense actually benefit the family? And finally, Section 6, our ultimate bullet review. Okay, we've built up the mental scaffolding. Now it's time for the rapid-fire, high-yield bullet review to really lock this in. Pause the explainer right here if you need to take notes. These two comparative rules are easily the most frequently tested traps in gross estate computations. Inheritance received during marriage, exclusive in both regimes, but the fruits of that property? In CPG, the fruit drops into the family pot, but in ACP, the exclusive tree bears exclusive fruit. And these? These are your always rules. Memorize these absolutes and you are going to save yourself so many precious minutes of second guessing on exam day. Income from your hard work is always shared, your criminal fines are always yours alone, and a massive procedural rule to remember. You absolutely cannot claim the family home deduction, which is capped at 10 million pesos, by the way, unless you have properly classified and included that home in the gross estate first. The basic rules are straightforward, but the LECPA is designed to test the exceptions. Understanding the logic behind the law, like exactly why gambling losses are exclusive or why a prior marriage totally alters the ACP default, that is your ultimate cheat code for 3-year retention. Once you grasp the why, the what naturally falls right into place on your balance sheet. So are you going to get tricked by a diamond necklace on exam day, or will you remember the golden exception? Go out there and absolutely conquer that exam.